Good afternoon. My name is Summer, and I'll be your conference operator. At this time, I would like to welcome everyone to the NSP webinar on Expenditures. All lines have been placed on a listen-only mode. Later, we will conduct an interactive question-and-answer session. If you would like to ask a question during that time, simply press star then the number 1 on your telephone keypad. You will hear a tone acknowledging your request and a prompt to record your name. If you'd like to withdraw your question, press star then the number 2. Thank you. I will now turn it over to Mary Palman. You may begin.
Thank you. Good afternoon, everybody, and welcome to the HUD NSP webinar on expenditures and other financial issues. I just want to go over a couple things very quickly, and then I'm going to turn over the presentation to John Laswick from HUD. The speakers today, we have an all-star lineup from HUD: Paul Webster, John Laswick, David Nagura, and Hunter Kurtz. And I am here along with Kathy Kaminsky from TDA to assist you all with the process of asking questions. While John and the team have some slides to go over and some information to present to you all, this is really meant to be an opportunity for all of you to ask questions, particularly around expenditures, as you're rushing forward to try and meet the spending deadlines. So even though Summer very briefly went over the process of asking questions, let me do it again because that's what today's session is really all about. So how do you ask a question? You do have the opportunity to ask the question by voice, by phone, so that you can do follow-up if you need to. And as Summer said, press the star key and then the number 1, and then you will be added to the queue. And as the slide tells you very clearly, press star 1 if you want to be removed from the queue if somebody already asked the question you were dying to ask. The other thing that you can do is if you don't want to ask the question in person, you can type into the Q&A box in the tool in WebEx and ask your question to all panelists. And what we will do is Kathy and I will take turns reading the questions to the HUD panelists, and therefore you can get your questions answered. So very simply, if you want to ask a question on the phone, hit star 1. And we'll go over these directions once again when we get to the end of the presentation slides, just so that everybody knows how to do this. I'm now going to turn the presentation over to so that he can go through the slides for you.
Thanks, Mary. Hello, everyone. Nationwide, this is John and Hunter and Paul Webster. David will join us, and we have Jennifer and Jesse as backup if we need it, so we hope to answer all your questions today. We had a session a couple months ago that we thought went pretty well about it was a question and answer forum, but it was sort of along the lines of had some more a topic to it, and once we thought that we could get the expenditure topic and accounting questions and the things that you know always come up in these areas, Paul Webster came to mind. So we were really glad that he agreed to join us. He's been a tremendous help to us on the NSP program, and somebody that everyone here at HUD regards as more or less the ultimate authority on these things. So you can't really get a better source of answers. You might not like the answer, but we can guarantee you it will be correct. So today we will be looking kind of at the policy of expenditures, and Hunter's going to talk for a bit about where we stand on drawdowns and expenditures. You know, we still have a ways to go in all 3 programs, so we'll set the context there. But then it really will be Paul talking about some of the policy. And most of you in NSP2, I think, have run up against this set of issues before because you had an expenditure deadline. NSP1 and 3 have not really had expenditure deadlines yet, and it's a little different than an obligations deadline. So the definitions will be a little bit different, and we want to make sure you're straight on those. So today is really kind of the policy side of it, and then on Thursday we have a companion piece with Ryan, Jim Yurden, and Janine Cuneo, who will be talking about the procedures. How do you log your expenditures into the QPR? Because if you haven't realized it yet, we are not looking at drawdowns as our source of information here. We are looking at the expenditures that you report in your quarterly progress report. So, I'm going to get into that a little bit more later, right? Yes. So I won't go there now. So we're going to look at the deadlines. We're going to talk about the rules and the policies, and then we're going to take a lot of questions, and we'll have plenty of time for that here. So, and we are trying to showcase some of our interesting projects as we go along here. So this one in St. Petersburg looked like a beauty. So we got these off the website. So Hunter's going to go with explaining the expenditure deadlines and where we stand today.
Well, as I think all of you know, in the next few months, or hopefully all of you know, it'd be a little concerning if you don't know, that the next few months, each one of the 3 NSP programs will be facing an expenditure deadline. The first one for NSP1 will be taking place in March or February or March, depending on when everything was signed, revolving around your grant. And you need to have expended 100% of your funds, and that had given you 4 years to do it. Right now, our national average is about 96.1. So we are very, very close, and I think John has some specific numbers to talk about.
Of the 307 NSP1 grants, 165 have gone over 100% as of today. And unfortunately, 49 have not gone over 90%. So we're spending a lot of time worrying about those communities, and if you're one of them, you should be getting in touch with somebody unless you're pretty sure that you got it covered.
NSP2 needed to expend 100% of its funds within 3 years, and that deadline is the same for everyone, February 11th of next month. Right now, we're at 88.5% expended for all grants.
Yes, and there were 56 NSP2 grants. 12 of those, as of today, have gone over the 100% mark. 8 of them are below 80%. So we have technical assistance out in most of those. And let me mention that if you haven't been frustrated by it yet, and we'll talk about this more, and the DRGR system has been having some capacity problems and that we're working on, but what we're trying to do as a result of that is to clear the decks so that NSP2 grantees will have less competition as they approach their February 11th deadline. And what we're planning to do is to issue a authority to postpone your submission of NSP1 and NSP3, certain NSP1 and 3 reports until March. So we'll be publishing a notice on that. But anybody that's been on the DRGR system in the last week, I think, has grown a few extra gray hairs with some of the time delays that we're seeing on that one. So we know about it. We're trying to fix it as fast as we can. We have the money, so hang in there with us.
NSP3 has 2 deadlines, and the first one is quickly upon us here. Again, March and April of this year, depending on, again, your grant date, you need to expend 50% of your funds. And right now, we're at 26.2% expended. Again, this is, we got a little work to go here, and
yeah, I think we're all a little concerned about NSP3. I realize most of these grants are coming behind NSP1 grants in entitlement communities and states, and so hopefully you just got it sort of timed out that you're going to get through your NSP1 and then hit your NSP3. Out of the 270 NSP3 grants, 65 have gone over the 50%, which is about a quarter. And unfortunately, 25 grants, almost 10%, have not spent any money, or at least have not drawn any money as of this date. You know, I know these amounts are lower, and you know, they're coming behind projects. So we're hoping that they're in the pipeline. But again, if you're feeling any kind of heat on this stuff, now is the time to ask for some help.
One thing we really want to make clear, because we've seen a lot of, we've talked a lot about the closeout, is that closeout and expenditure deadlines are not the same thing. The expenditure deadline is a requirement that you spend an amount equal to your original grant. That can be any combination of grant funds and program income. Closeout is when you've met all of your national objectives for all the activities you've undertaken. So that includes getting somebody into a house, or having a multifamily property meet its stabilized occupancy. These are the type, you know, does not need to be accomplished by your expenditure deadline. Only the spending of funds or expenditure of funds needs to be met by your expenditure deadline. The other thing we've heard a couple of questions about is, oh, it sounds like we don't have expenditure deadlines anymore. That's not true either. There is a set date for your expenditure deadline. There is no set date for closeout, but they are two separate things. So please don't confuse them.
All right. Many of you received letters in the last few days, or will be receiving them in the next couple of days, if you're under 90% expended in NSP 1 or 2, or under 45% in NSP 3. So that's a lot of letters coming from your field offices. You know, in many cases, hopefully these are just discrepancies between the amounts that you've drawn and recorded through the DRGR system in order to get your money, and the additional step of going into the QPR section of DRGR and reporting the expenditures in there. So that's the number that we're going to be focused on today. But as Hunter said, it's not the same thing. You don't have to have your whole program done. You just have to spend that amount of money. So, what's up next? Oh, more pictures. I like this. There's a house in New Haven that an NHS affiliate did that looks a lot like this too. I love these porches.
All right. Before I turn this over to Paul Webster to talk more about expenditures, I just want to go over one thing, and that is that the difference between an expenditure and a drawdown in DRGR. When you draw down funds in DRGR, you're taking the money and then you have taken the money to either pay for an expenditure or you're going to expend it. But when we look to determine what your expenditure is, we are not looking at the drawdowns in DRGR. We are looking what's in your QPR that is specifically stated as an expenditure. So please, some of you may have gotten those letters and thought, oh, well, you know, with my program income, I'm over 100% expended. But you got the letter and we're a little surprised. That's because your drawdown and your expenditure rates are different. So you need to go into DRGR and clean up your QPR to make sure that you're making very clear what exactly you've expended. So I'm going to turn it over to Paul now. And
hey, what that means.
Oh, I'm sorry. One of the just sort of briefly mention this. Again, just sort of talked about this. The difference between you need to expend an amount equal to your original grant. So if your grant was $5 million and you got $400,000 of program income, all you need to do is expend $5 million. You could still have in your line of credit $400,000 because you have to spend program income first, so you spent that $400,000 before you went and drew any more funds from your line of credit. So that's why, you know, we sort of fixed this a little while ago because of this program income issue, first in, first out, and so just make sure, don't be worried that come your expenditure deadline, you still have funds in your line of credit. You will still have access to those as long as you've met your expenditure deadline.
Right.
All right.
Now it's Paul.
Hello, everyone. So the The general rule of expenditures, as Hunter mentioned, expenditures and drawdowns are not the same thing. Expenditures and disbursements usually are not the same either. The term expenditures is an accounting term. It's a little broader than maybe in the private sector, because in the public sector and with federal grant programs, you can do things that private businesses, for example, don't do, like give money away. So the basic rule is you look at the amount of payments or cash disbursements that have been made to contractors, employees, homeowners, other entities that are receiving payments for an activity under the NSP program. Add to that the amount that you've been billed or invoiced by contractors. That would be, for example, if you, as a grantee, have entered into a contract with someone to renovate a foreclosed-on property, that you'll be getting, from time to time, invoices from contractor, and even if you haven't paid that invoice, you have, in effect, received an economic benefit from the work done by the contractors. So you get to count that as an expenditure as well. And of course, a lot of the NSP funds have been used to pay sellers of foreclosed upon properties, so you count that. Go to the next slide. You can also add accrued salaries and related fringe benefits of your employees, so that if you have somebody charging his or her time to the NSP program, accrue that person's salary up until the deadline date, and that's a bona fide expenditure. And finally, you can include any indirect expense or costs that have been incurred, as long as it's done pursuant to an indirect cost allocation plan that is prepared and sometimes approved in accordance with the OMB circulars, either A87 for governmental entities or A122 for non-governmental entities. Yeah. The main thing I think that you need to worry about is documenting what those expenditures are, particularly when you're including in the expenditure total amounts that have not actually been paid. So the kind of source documents that are sort of classic source documents are contracts, such as a construction contract, invoices that have been received from third parties, you have real estate transactions where you have purchases involved, closing documents, or closing documents on loans, as well as the related loan documents such as promissory notes or loan agreements. If you have a subrecipient relationship with a third party, then you need to have those documents. You need to maintain payroll information in accordance with the OMB circulars, so that you can document both that someone has actually incurred an expense, and also in some situations you have employees working on more than one program, they may require time distribution records. Finally, as I mentioned earlier, if you're going to charge indirect cost, you need an indirect cost proposal that would have been prepared in accordance with the OMB circulars, and in certain cases submitted to the cognizant agency for the grantee or subrecipient for negotiation and approval. But that would be the source document for indirect costs that are incurred. Now, there's some special cases that come up in the NSP program. One has to do with payments to developers. The developer, when funds are made available to a developer, that entity is the entity that's actually incurring a cost related to the project. That would be, you may make a loan or a grant to a developer who's acquiring a property and rehabilitating it and will manage it perhaps after the work is completed. So what you will need from the developer is information that would support any payments that you made to the developer. So whether it's a loan or a grant, that the payments to the developer should be supported by the kind of information that any entity would keep related to a project, the same thing basically that a grantee or subrecipient would keep. One issue that someone asked me about was, what about retainage amounts? So maybe there's an agreement with a developer for the developer to do work related to property, but also the developer is required to or can't get full payment under the agreement until and unless the developer sells the property. And the agreement between the two parties might provide for a retainage. So maybe the base amount is $500,000 total, but there's a retainage of 5% of that pending the sale of the property to a third party. So the question is, do you get to count the retainage amount? And generally speaking, the answer is no. If there is an agreement that requires performance by the developer in order to get paid, and there's an amount attached to that performance, then until that performance occurs, there's really no obligation or no requirement that the developer be paid. So now that's the general rule. There may be exceptions based on the way an agreement is written. Maybe there are some conditions that the developer has to meet that might be considered in a legal sense is to be ministerial, required by the contract, but not really that substantive, such as just submitting a certification or something like that. I think in those cases you could count the amount as long as the work has been done and the performance has occurred. I'll skip back a minute to the issue of retainage under construction contracts. Now, that's a different story usually. If you have, as a grantee or a subrecipient, you've entered into a construction contract for someone to do something, improve your property, and it's your property, and that improvement has occurred, then and as long as the contractor is required to treat any work as having been completed, usually that it's done under the percentage completion method, then you can also count that cost. So the only exception would be where there is something or some conditions that are amount to a delay in the developer or in the contractor recognizing income, say for tax purposes. If the developer can't recognize the income, then you can't recognize the cost, would be the general rule. So that's a kind of a technical point, but it may come into play at some point. But generally, under retainages under construction contracts, as long as the work had been completed, you would have economic performance, and therefore you could recognize the cost associated with that. Talk a minute about disbursements into loss reserves. That's been a feature of the NSP program since day one. And there are situations where a grantee or subrecipient might enter into an agreement with a third party, usually a bank or some other lender, that will amount to a guarantee of a portion of the loan made by the third party to a beneficiary, a program beneficiary. And so you might have, in order to support that guarantee, set up a loss reserve, and the lender usually requires those kinds of reserves to be established, so they will know that there's some funds or a source for payment under the guarantee or credit enhancement given by the grantee or subrecipient. So in those situations, the disbursements into the loss reserves can be treated as an expenditure, as long as the amount that's dispersed into the loss reserve reflects what would be expected to be the loss on the loan, and that's usually based on an agreement between the grantee and a lender as to what that would be. But as long as that's done, the amount of disbursement into the loss reserve can be counted as an expenditure.
Paul, when you say dispersed into the loss reserve, that's per property, right?
Or per transaction.
Per transaction, right.
So you can't have somebody say up front, the lender say, well, we'll make $5 million worth of loans in this target area as long as you put up $1 million in reserves right now up front. Well, you can't do that. But you can enter into an agreement where the lender might agree to make loans up to totaling $5 million, and you agree to cover a 20% of that based on some evidence or some historic loss experience for those kinds of loans. And as you make the loan, as the lender makes the loan to individual loan to a third party, then an amount equal to 20% of the loan, in our example, can be dispersed into the reserve. Lump sum drawdowns have been an issue since day one when grantees realized in many cases they could use the authority under our regulations at 570, 513 to draw down in a lump sum an amount to be placed into an account with a financial institution who would then agree to do certain things, such as making loans they wouldn't make otherwise, or make loans at a rate below what they would normally charge. And so the question was, initially, was that an obligation? Answer to that was no. And likewise, it's not an expenditure, just simply putting the money into this lump sum account. The use of the money in the lump sum account is what counts as an expenditure. So you might have, again, $5 million placed into a lump sum drawdown account, and that money would be used over a period of time to make rehab loans, rehab grants, also could be used for loss reserves, things like that. And as those individual activities are carried out, that's when the expenditure occurs, not when the lump sum drawdown is made. So I think that's one of the issues that everyone should understand by now. I think we've given guidance on this, but just to reiterate it. So talked a little bit about what expenditures are. We'll say what expenditures are not. They're not, for example, future administrative cost that might be might actually be known to be necessary, but they wouldn't have been incurred at the time of the deadline, so they don't count in the expenditures. If you have property that's under construction and not completed, that wouldn't be the uncompleted portion of the contract couldn't be treated as an expenditure. As I mentioned earlier, usually the contractors will calculate the amount they're owed, and they will invoice based on a percentage of completion method, that's the way you as a grantee or a subrecipient then would treat the cost. So income to the contractor would be a cost to you. So if they use the percentage of completion method and 80% is complete, then 80% of the cost are allowable as to be counted as expenditures, 20% would not be. And finally, property that's to be purchased that isn't under a purchase agreement, that's under a purchase agreement, but the loan hasn't closed yet. Well, under the definition of expenditure, under the applicable regulations, if the property ownership of the property hasn't been taken, you're not able to count that as an expenditure. You may have incurred some costs related to the leading up to the purchase, that kind of thing, and you can certainly count those, but you can't count the actual acquisition of the property until basically until the closing.
So something like environmental review costs or
environmental review, appraisals, that you have to pay for, other expenses, surveys, things like that. Right. So that's. I'll turn this back over to Hunter.
All right. So what happens at expenditure deadline? Well, if you've met your threshold, then you can continue to use the remaining funds in your grant line for eligible costs. And just want to point out that the only time we really take into consideration the funds that are in the line of credit is, and the way they're spent, is at closeout. So you're not going to be able to close out the grant, which is going to be in the future, not the expenditure deadline, when once any project that has any money from a line of credit, from the line of credit, has met a national objective. Once that threshold's been met, then you can close out. So just sort of keep that in mind as you are sort of planning here in the future. If the threshold is not met, and this is verified, HUD may recapture unspent funds. For NSP2, that goes back to the U.S. Treasury. NSP1 and 3 will go to the disaster fund. No extensions to the deadline will be granted, and HUD will base recapture on finding of noncompliance on an individual basis, considering hardships, etc. Right.
So we have another webinar Q&A session coming up. We're not deserting you here towards the end. We are kind of lightening up on the webinar schedule for the next 6 weeks or so, but we tend to fill those in as we need them. And so we have a session on January 31st for questions and answers. So.
And we'll have a couple more in February and March, solely for the question and answer on the deadline. We will be getting a schedule out about those here in the near future. The next question is, what happens if the grantee expends 100% of its grant but and misses the 25% set aside? Right now, 74% of the NSP1 grantees, 24 of the NSP2 grantees have not met the 25% set aside. 178 of the NSP3 grantees have not gotten at least 12.5% expended. Now, it is not a requirement to expend 12.5 by the 50% deadline, but it is sort of a good yardstick in measuring your progress towards meeting that deadline. So that is something you should consider as we continue to go forward. If you don't meet the expenditure, you'll receive a finding at the deadline. You must have the spending requirement at its deadline, but have until closeout to meet the national objective by occupying units. So you really can't, I mean, you will, we want you to have that 25% set towards the 50% AMI folks, but you really can't meet that requirement until someone's in the unit and the national objective's been met. HUD will require repayment or make grantee use own funds to meet the requirement for the 25% set aside. And we just want to note that recapture of all funds is possible.
Hopefully not likely, but
so that is our presentation. We just want to do that quickly here and turn it over to sort of take your questions about expenditures.
Right, and Mary is going to be the moderator for that portion of the program.
Well, we have 9 written questions so far, but I don't know if anybody who's on the webinar wants to ask a question in person. And as you know, you can go in, hit *1 and get yourself online to ask a question in person. So do we have anybody so far who would like to ask a question in person?
Looks like Lois Colson would.
Okay. Kathy, can you get her in?
Summer, our operator, is going to have to help with that. Summer, is anyone queued up on the line?
Not at the moment.
Okay.
All right.
So I'll start with the first question that came in from Cindy Emtoff. It says, long ago we met the expenditure deadline for our NSP1 grant, but we've had so much program income that we must always use the program income before we use the grant funds. Of course, that's correct. Will there be a time deadline by which we must draw down the grant funds completely?
I know she wrote that question in before Hunter just talked about the last slide, but yes, you won't be able to close out your grant until you've spent all the funds in your line of credit and met a national objective with any projects that those funds went into. So, you know, that date could vary. We have some pretty large amounts of program income.
So when is that date?
When
does it have to be closed?
Well, there is no specific date for closeout at this point. We'll probably get, we may impose a deadline in the future, but right now there's nothing that's required.
And if you have a problem, just think about maybe, you know, expanding your program to expend more of that program income so you can start getting into that line of credit.
One way to do that is through a revolving fund. If you have something like a rehab program that makes loans for families to fix up houses and then gets repayments over time, the money that you put into a revolving fund doesn't have to be tapped for the next cash need the way that other program income would be. So NSP2 is probably has a little bit more of a concern until we get the waiver from OMB. We still expect that. NSP1 and 3 are what the insiders here in Washington call no-year money, which means that it technically never really expires. So so unless HUD eventually sets a deadline, there really isn't one in front of you.
The next question comes from Deborah McRae, who writes, did not understand the DRGR comment. Does this affect the quarterly report due at the end of January?
And Mary, to clarify, this one came in shortly after you guys were talking about the DRGR, the problems with DRGR right now, the issues, the speed, and stuff like that.
Right.
I'm not the, I think that'd probably be a better question. We'll probably have some more details about what's going to take place on Thursday concerning that. So, you know, vaguely, I don't think it's going to affect the QPR directly, but again, I can't say one way or the other. We'll have more details on. Oh, wait, now we have the expert coming in.
Jennifer Hilton.
So we're going to be issuing a memo for the QPR for the fourth quarter of 2011 that is due January 30th. So NSP1 and NSP3 grantees that are already 100% expended, And also all CDBG disaster grantees are going to get an extension to submit their QPR until March 15th. So we're going to put that out on the CPD listserv with all those details, and that'll go out sometime this week.
And I think a corollary thing, if I'm not mistaken, is that you will be having to open up the next QPR, right, the one for this quarter that you would normally not go into until April. That's where you're going to be reporting your expenditures for this deadline period. So it doesn't affect the one you just filled out. You can punt that one, but the one you need to worry about is the next one, really.
Right, and he's just talking about opening your QPR, updating your expenditures, and then you save it and close it. So in that case, you're not submitting a QPR, you're just updating expenditures. And as soon as you save that QPR, that information goes into the system and we have it, so it's updated.
Thanks, Tim.
I think that answers the question that Carrie Douglas is asking, because she asked what's the best DRGR report to review to confirm all your expenditures and the QPRs. So I take it you're looking at the first quarter of this year.
Right.
Okay.
Well, it's not just the first quarter of this year. We'll also be looking at expenditures, depending on where your deadline is.
Right, but I mean, all deadlines fall in the first quarter with three exceptions. So.
Right, and what we'll do is we pull a report in DRGR for expenditures, and that report gets its information from the last updated QPR. So the last QPR you opened and updated and saved, that information will be in our report that we pull. So even if you haven't submitted a report at the beginning of 2012, we're still getting that information if you put it in and save your QPR.
So this is what goes back to what we were talking about, the difference between drawdowns and expenditures in DRGR. You have to go into that QPR and mark down the expenditures for it to count.
Okay. We have a question from Paul Dennison who asks, can you summarize again the condition that a retainage can be counted as an expenditure?
Well, again, I talked about two different kinds of retainage arrangements. One for where there's a retainage under a contract with a developer who has to perform certain responsibilities, including selling property. In those situations, the retainage generally would not be treated as the amount of a retainage that might be otherwise payable would not be treated as an expenditure because there hasn't been complete performance, including economic performance under that arrangement. The other situation I discussed was in connection with construction contracts that a grantee or subrecipient enter into property they own, in other words, to that will have retainage provisions until certain things are done. The retainage, for example, ensure that subcontractors are paid. The question is, can those retainage amounts be included in the expenditure amount? And the answer is generally yes, because it's still the contractor has performed in an economic sense. That is, they've either built you something or they've done something else for you that you would have ownership of, and so you've incurred a cost, and usually those costs are invoiced based on a percentage of completion method used by contractors to recognize revenue for their own purposes, usually for tax purposes. So that's the situation where they are retainage amounts can be included in the in the expenditure as long as it's would otherwise be paid. For example, if you have an 80% complete project and there's a retainage associated with that of a certain, then that would be something that you wouldn't have to that you would include as just expenditure. If you were 100% complete, but there was a retainage, say, of 5%, you could include the 100% in the expenditure amount as long as there's not something under the contract that requires or that would preclude someone from saying that there's been true economic performance.
Yeah, you're sort of balancing off objectives here, because the point of these retainage fees is holding back payments on some of this is to make sure that the project turns out all right. And a lot of times you don't know that the construction's been done properly until the end of the project, and so you want to have some leverage. And at the same time, you want to have your NSP expenditures, look as good as possible. But frankly, I would rather lose a little bit of, face in NSP than lose my leverage with a contractor for a building that's 95%.
But the wonderful thing about that is you can have both. You can count the
95.
Well, you can count the full 100% as an expenditure. You can still hold funds back from the developer, from the contractor until it complies with whatever the condition is.
Not a developer, though.
Huh?
But a developer wouldn't have the same.
Well, it's a different situation there. You don't own the property, and the developer still has to do certain things under the terms of a contract. So.
Let me stop here and ask Summer if there's anyone who's wanting to ask a question in person.
Yes, you do have phone questions. Your first one comes from Jose Dorado.
Hello?
Hi, Jose. How are you?
Hi, good. So I'm kind of confused on the expenditure LH25 requirement with the program income. So we're facing a February deadline. So I'm a little bit short on meeting the 25% requirement with program income factored into the equation.
Okay.
So I do have a property right now that is completely rehabbed and ready to be sold, but I don't want to sell that property until I know if I have to meet the LH25 requirement with the PI added by, I guess, the end of February.
Well, I mean, we're going to be looking first at the 25% of your original grant amount.
We've met that.
Okay. So then you have to spend 25% of program income.
Correct. And we have a developer actively looking for properties to meet that requirement, but they've faced some challenges because of the market conditions.
Yeah. So we're not going to be expecting you to be there at this deadline.
Okay.
We realize that, I mean, you may have gotten program income 2 weeks ago. It's
correct.
You can't have spent it.
Because if I sell this home that I have right now, that's going to be PI, and it's going to put me in a situation where I'm going to be short on the LH25 by selling this property.
Right. Well, so you have some time. I mean, I think that what you want to evaluate, and you probably have already done so, is that just to make sure that at some point you will have enough future program income to meet that 25%.
Oh yes, we will. Yeah.
I would not be concerned at this point.
Okay. Sounds great. Thank you.
Your next question comes from Franz Dutes.
Yes, good afternoon. I have a question in regards to the use of NSP3 funds along with NSP1 funding.
Okay.
Specifically, can you share with me how it would be reported in DRGR if we have acquired a property using NSP1 funding and proceeded to use NSP3 funding to rehab that property?
Well, it would just be reported as to the source of the funds. So it sounds like it's a fairly clean split here. You would report the acquisition into your NSP1 program and the rehab into NSP3. Now you might, sort of prorate the soft costs and activity delivery costs and those sort of things, proportionally to the amount of money. But that more or less just follow the source.
What about the beneficiary information and 25% low income requirement? How would I determine which grant I would use for that?
We've got a situation where we ask you to report both, report them in both systems, and then we have a program that removes duplicate addresses. So you're reporting, when you've actually occupied a unit, you're reporting an address, and we knock out all the duplicate addresses so that, but there is, in fact, the total of all three programs is going to look like more production than the net production figure, but we let Ryan wave his magic wand over those duplicates.
Okay. Now, what if Ryan waves a magic wand and I need that 25% in NSP1 and I was given credit for it in NSP3? What do I do then?
Well, yeah, it's going into both. So, it's one unit. Let's say it's one unit. You're going to have one beneficiary. It's either LH25 or it isn't.
Okay.
Right?
No, it's the dollars you mentioned.
Right. Yeah.
Beneficiary.
But
it doesn't matter.
So the acquisition cost in NSP1, if that's how you acquired the home, would count towards your LH25, and then the rehab cost would also count towards your LH25 and your NSP3 because you are you're spending both. It's not you don't have to count for the person. It's
right,
the money that we're interested in.
Yeah, it's the dollar amount. That's good.
Got it.
Well, we're going to have a webinar Thursday, that's going to go into more detail about DRGR. So if you have DRGR questions.
Yeah, but it's a good point.
Yeah.
I think a lot of people get confused. The 25% set aside is not 25% of your units. It's 25% of your grant. So it's strictly based on dollars.
Gotcha. Great. Thanks for clarifying that.
Your next question comes from Lois Colson.
Lois.
Hi.
Hey, Lois. How are you?
Hi. Can you hear me this time?
Yeah.
Hi. I have just a little bit of a nuanced question, so it's easier to ask in person. Do you guys have a canned report that you had back at the first deadline we could use to see what you guys are looking at as our expenditure number?
I think we actually just sent those out to the field, and if we're sending warning letters, so...
But I mean one in that we can pull every day if we wanted to look, because I realize what you're saying about entering the expenditures manually, but I guess here's the larger, nuanced part of the question. When we go into our QPR each quarter, we're putting in our expenditures for that quarter.
Right.
If we've missed any expenditures in previous quarters, all the way back to 2010, and I don't know if I figured this out on the first deadline or not, but what if we've missed some? Are we adding them to this active QPR to make sure that they're showing?
Yes, you are.
But how do I know what's missing if I don't have a report?
There is a report in MicroStrategies.
Okay.
That will give you your expenditure total.
Which one do you look at? Because when I open up those reports, I got to be honest, they use different terms in each report, like disbursement versus expenditure versus drawn, approved, completed. I get lost. So if you guys know which column you're looking at in which report.
Right.
We'll find somebody who can answer that question for you before we finish the webinar.
That'd be great, yeah, because it's a very specific question, because if I don't know which exact number report and which exact column you're looking at, and then to add on top of it, I think, as far as I can tell, we have to run two reports every time, one for the PI, for the program income, and one for the grant funds, because there doesn't seem to be one there that it combines the two, which is okay. I don't mind running two. And I realize that you guys have done some great webinars on how to make all these fancy reports in DRGR, but way over my head, and I didn't have time to figure it all out. So I'm still trying to use just what you guys provide, which, if I can find out which one, that'll be helpful.
If you pull your QPR and get, like the latest, your January to April or January to March QPR for 2015 and open that up, and you go to the print screen version, there's that page that's like the summary page, and it says right there total expenditures. It says quarter and then it says to date.
Oh, right.
So that will be the number that's expenditures to date will be the number that we'll get in our report that we pull.
Okay, good point. So do you know, is this Jennifer?
Yes.
Hey, Jennifer. Do you remember if that is, because I don't recall, and I've looked at a million QPRs, but is that the aggregate of all the activities, or does it tell me for each activity what I've drawn to date?
Aggregate for all your activities. I'm pretty sure it says total expenditures.
Okay. And then if I go through actually now that I'm thinking about it, I think if I go through each activity on the page itself, it has a summary of to date drawn. And that's how I'll check and make sure that I got all the expenditures in there. Okay, that's good.
So if you missed something back last summer, we would just add it into the current.
Right.
Okay.
Right. And that also will help with, I mean, I guess the other part of this is we've moved vouchers. You know, a house became LH25 later, so that's just making sure that all those vouchers get put into the right activity. So that'll be helpful. Thank you.
You're welcome.
Hey, one quick question. I wrote it in. I'm not sure if it went through. Is Howard Kurtz still there? Could he mention the section again about the lump sum drawdowns?
575.13.
575.13. All right. Thank you.
So, for the name of the report, or are you looking at the QPR?
Yeah, I'm looking at the QPR that I printed out to see. It does give the total funds expended, but I don't see.
We get the total funds expended in the quarter and then to date.
Right.
So that total funds expended to date, that's the number that we're pulling. So you can always check, open your January, February, March QPR, look at that number, and know that that's what HUD is looking at to see if you met your expenditure deadline.
And if you look by activity, it will also tell you total funds expended by that quarter and total funds expended by that date. There's no easy list of it all, but you can look by each activity type or title.
More questions?
Your next question comes from Joshua Northey.
Hi, this is Josh Northey with MHP, and as we're providing TA, sort of my question gets to how, what is the actual process you guys are going to be using for, you know, evaluation? I mean, I think it sort of ties into some of the other questions because the QPR reporting period obviously doesn't match up with the expenditure deadline periods. So if I'm helping, you know, community XYZ who is on their current report going to be, you know, the one for the quarter that just ended, they're going to be not at 100%. They're not going to do another QPR where they'll hopefully be over 100% till well after the deadline. And so obviously we're focusing on making sure they have all their expenditure documentation in order and dated properly, et cetera. But is there some additional report they need to do or some note in this QPR or in the next QPR about what the figure was at the deadline? Is that clear?
They need to go in and we were kind of talking about this earlier, go in and to this quarter's QPR, enter the expenditure data and save it.
Now, when we say this quarter, we're talking about January, February, and March of 2013, not the one that's due this month or the last quarter, this quarter.
Okay, so you want them to make a draft of the upcoming QPR.
Exactly.
Yes.
And then save that so that you don't have to do it twice.
And I mean, they should be doing that as they make expenditures so that we keep, and they can keep track of how they're progressing.
And then what we will do is, as each deadline arrives, we will take a snapshot, even if it's on a weekend for NSP1 and 3, and take a look at, you know, your total expenditures. If you're very close, above or below, or you've just recently reached 100%, we will most likely have the field offices reach out and review some of your, you know, look for a sample that they will specify of several different projects to do that validation. So I think that was kind of embedded in your question there. So there's nothing that the grantee has to do at that point except just to make sure that that QPR is as accurate as possible. But there's going to be cases, if you can see that, if you've received an invoice but you haven't made a payment, or, the invoice, you may not have 100% payments made as of the expenditure date, so deadline date. So we're going to be checking all that, and if there's discrepancies or if people fall below the requirement, then we will do an analysis on an individual grant basis.
Summer, do we have any more in-person questions?
Yes, we have a question from Jason Pearson.
Hello.
Hello.
Hi, this is Jason Pearson with the New York State program. I believe I know the answer to this question based on what you said earlier in the webinar, but I just want to make sure I'm absolutely clear on this point. Back in May of 2011, we submitted a question through the Ask a Question function looking for or asking for the definition of drawdown versus expenditure as it relates to DRGR. And at that time, we were told that as a state grantee, we should be reporting our expenditures in DRGR to match what our actual drawdowns are. And as a result, since the inception of this program, it's resulted in us looking like we have much lower expenditures than in fact have happened. Everything I'm hearing here is telling me that that guidance we received back a year and a half ago is incorrect, and that even as a grantee, we should, excuse me, as a state grantee, we in fact should be reporting actual expenditures, not just what's actually been drawn down through DRGR.
That's correct, but I will say that I'm glad to hear you have that problem, because a lot of folks are having the opposite problem, and I think that's why you got that advice. Is that people aren't putting down their expenditures and they're drawing down the funds. So
I think there's been some further clarification of expenditures subsequent to that time too, particularly when we got to the 50% mark for NSP2. So I think that sometimes these answers tend to be on the careful side just in case, but you can in fact go through and list everything that Paul's pointed out as an expenditure in your QPR.
Okay, very good. And just a quick follow-up question. I mean, and just the gap between our expenditures and drawdowns is usually caused by there's an often significant delay between when one of our subgrantees expends funds and when they actually requisition us for a disbursement and we draw it down. That's what's causing the delay. And if I'm hearing correctly, I expect then when we reach our expenditure deadline, there is still going to be somewhat of a gap between what we're reporting as expended and what's drawn down in DRGR, and what I'm hearing correctly, we will be able to ultimately draw down what we've reported as expended, but perhaps the field office may be looking to us for some sort of verification that the funds that we report as expended but were not drawn down as of the deadline were in fact properly expended.
So they haven't invoiced you at all, the subgrantee level?
Correct. Exactly. That's what I'm talking about. It could be they either. Well, I know that as a fact, as of when we hit the expenditure deadline, there are going to be some expenses we haven't been invoiced for because we have some projects that have multiple funding sources and are going to be running past the deadline, and so we will not, have some invoices as of that deadline. In other cases, will in fact have been requisitioned, but we just have not on our end, will not have been able to process it yet.
Right. Well, I mean, from the point that it hits you, you're okay because you don't have to cut a check for it to count as an expenditure. The period you have to worry about, as you already know, is, well, how do I get that number from my subrecipient or subgrantee? And if you can get them to get those to you at this point, that, at least get the invoices to you, that will make your life a lot easier. In the event that you come up, a couple $100,000 short, let's say, because the subgrantee hasn't gotten you an invoice yet, that's that 30-day period after the deadline that we will be looking at these these situations, and you will have, you know, in effect, a couple of weeks to get the paperwork in, but it can't be for work that was done after the deadline, so it's still going to have to be completed, you know, work completed up to the deadline. But if you don't have 100% of your paper, you will have a couple of weeks to get that straight.
Okay, thank you. That's very helpful.
Okay, good luck. Yeah, it's going to be a problem for state, so I would think a lot of we got a bunch of good-sized NSP2 consortia.
I think that if I were a state, what I would be asking for from subrecipients is a report. Not even, doesn't have to be an invoice or a request for payment. It would be a report that would specify expenditures under the definitions we've been talking about, and then have that report be certified by someone in a position to do that with the subgrantee, CFO or someone like that, or a finance director if it's a locality, and have that information then just provided to the state and use that as the basis for entering the information in the QPR. So I don't think it necessarily has to, you have to wait for a drawdown request per se, but, you know, it may just be that if you could have gotten that, if you could have gotten the report, you could have gotten the drawdown request as well. So it's just a matter of what your relationship is and how quickly your subgrantees can move.
But on the other hand, I mean, the state could prepare some sample reports and just have those sent out, so at least they're getting the information.
Oh yeah, I think that's what I would do if I were a state, but it may be a little bit late for that at this point. But I would try to get a report from the subgrantee that certifies that this is the amount of whatever they've listed in the report is reflects the actual expenditures up to the deadline date.
That's pretty good.
John, this is Mary. Could consortia or groups that have come together under NSP do that same kind of thing like the states could possibly do, because they are waiting for their subgrantees or partners to get the information to the lead grantee?
Yeah, I think what they have has to be something that would withstand scrutiny, audit, or review by HUD monitors. But I would have everyone involved follow the same procedure, so you've got consistency, and a report as of the cutoff date would be one way to do that, and I would have the numbers certified by, again, someone who's in a position to do that, to confirm that these are the costs that were actually incurred. Usually it's going to be a chief financial officer or some equivalent if we're talking about a governmental entity.
Okay, thank you.
Yeah, so that's pretty good news, I think, for those of you with big, complicated grants.
Summer, do we have additional verbal questions?
The next question comes from Peggy Severson.
Hi, this is Peggy Severson at the South Dakota Housing Development Authority.
Hi, Peggy.
Hi. I don't know if this is a stupid question or not. I guess maybe I was too lazy to look it up. But under NSP3, we have a $5 million allocation. If at the 50% expenditure deadline we've only expended $2 million, does the $2 million then become our 50% number and we will only have $4 million to expend over the full time period?
Not necessarily. The grantee that falls short of the requirement will be evaluated, and we will take action based on the individual circumstances there. So it doesn't change your universe necessarily.
So we can continue closing loans and proceeding?
Yes.
Okay, very good. That's the right answer.
And I think if we were going to recapture, we'd only be looking at that 500,000. We wouldn't be looking at $1 million of your 500,000 or $5 million. I'm sorry.
And that's what we were hoping for. I just wanted to make sure that I didn't get us into a pickle somewhere.
Okay.
Thank you.
Sure.
Your next question comes from Bill Perkins.
Hi, it's Bill Perkins from the Wisconsin Partnership for Housing Development. I think I heard Paul say a while ago that acquisition costs cannot be counted as an expenditure until the building is complete. And I think if I heard that right, what I heard as complete in the case of a building for sale is closing on the sale. I want to make sure that I did hear that accurately and ask what the parallel requirement is for rental housing. And also, in that situation, if there are other costs that cannot be counted as expenditures.
Well, actually, I thought I said the opposite, that any cost, legitimate costs incurred up until the closing date are allowable.
Okay.
And it's really the acquisition cost that requires a transfer of title for the cost to be recognized.
Right. Yeah, but if you've already bought the property, you can count that as an expenditure. What we were trying to point out is that having it under contract is not the same as buying it. So, but if it's bought, that's fine, and then it's just a percentage of rehab or whatever that you can claim if you're not 100% finished.
Okay, so suppose you bought it, whatever, 6 months ago. It's rehabbed. It has not sold yet. Count the acquisition cost or not?
Yeah, you get to count all of that.
All right.
Because it's not a condition on sale of the property. It's a condition of what you've expended. You've expended the acquisition cost as well as all costs that revolve around or deal with rehabilitating the unit.
Right.
We're talking about acquisition when you buy it before you rehab it. You don't have to sell it to recognize that cost.
Now, you are going to need to sell it to meet your national objective without the grant. But that is, we're talking 2 years probably. Or, I'm just throwing out that number. I mean, it's going to be a while before we have to worry about that.
Got it. Thank you very much. I'm glad I asked.
There are no further questions.
We still have a couple of written ones from Simone Flores. Are there any provisions for expenditure deadline extensions for grantees that were hit by Hurricane Sandy?
Well, we recognize that there are some hardships that were created by that, but there will be no extensions. We will, if you fall short of the expenditure deadline, look at the circumstances and act appropriately.
Okay. This question is from Kate Kreider. This is a follow-up question related to the retention. She says the conversation so far has been helpful. We have a partner that has built in a 30-day hold for a contractor's earned retention. Is there a deadline for drawing this?
I'm not sure that's a expenditures question.
Yeah, so I think what Paul's been saying, let me test my knowledge. I think Paul would say, well, you can already count all of that as an expenditure. When you pay it is up to you. Is that correct, more or less?
Yeah, again, if you have a situation where you as a grantee or subrecipient own the property, we're talking about property that there's a contract providing for someone to build you something or to improve property you already own, and you have some sort of holdback provision in that contract, as long as that contractor has provided economic performance, I believe that's the term used by Internal Revenue Service at least, as long as that contractor has provided economic performance and you have the property, then and they've invoiced you for it, even though there may be something in your procedure that provides for a holdback of it, that allows you to provide for a holdback or retention of an amount invoiced for a while. Still, that is an expenditure. The only exception I think I can think of is if the contractor itself could not count that as and would not be required to count that as income, because and this is really getting into a fine point, but a lot of contractors like to defer the income from one tax period to another tax period so that they don't have to pay now, they can pay later. And the Internal Revenue Service has said, well, if you've performed under the contract, then you've earned income, even if there's some says you may not receive the actual cash for that performance as of the end of the the tax period. So if there's something in the contract that goes beyond a normal retainage, and normally the retainage is there to make sure that the contractor pays all of the employees, so there are no mechanic liens or no other subcontractor filings on the property. As long as that's the kind of thing you're talking about, then you can count the amount that would be subject to holdback. If you're talking about something else, that you go beyond, you get creative, and you put something else in there that goes that wouldn't require a payment. There's not been economic performance by the contractor, such that the contractor might not be required to count that as income, then you can't count it as a cost. But in most cases, if you're just talking about normal retainage provisions, then you're okay. When you're talking about contractors, I'm not talking about situations where there's a developer relationship with someone, and that developer itself has to perform some function, such as selling the property in order to get fully paid. That's a different matter, not the same thing.
Okay, thanks, Paul. This question comes from Cindy Tay. For NSP3, do we have to spend all of the funds allocated to administration by March 2014? Could we continue to use the leftover funds allocated to administration after March 2014?
Okay, this is an interesting question. You have to spend an amount equal to your grant. So if you have no program income and your administrative allowance, you're spending, let's say, 8% of your grant on administration, and you've only spent 4% of it, and your deadline rolls around in 2014 and you've 96% expended, then you're not going to get that money. So on the other hand, if you have program income, you don't have to spend up to your budget now. You can keep, you are able to go up to 10% of your grant plus program income. So with some program income, you could build yourself an administrative future by carrying some of that forward. But without program income, there's just no way to do it. So I know we've had some NSP2 grantees that thought they could kind of keep a little savings account there, and that's not the case.
Okay. Next question is from Charles Kelly. One of our sub-grantees wants to close out their grant before the line of credit in the administration line is expended. I've explained to them that all funds in each line of credit have to be withdrawn. They tell me that HUD said they could spend after that.
Well, I think we may be getting mixed up here between expenditure deadlines and closeouts again. So
right.
The closeout is something that happens in the future. In fact, Hunter's been having the pleasure of going through something called the Paperwork Reduction Act, which has aided greatly over the past few weeks, and he's not even finished yet. We will not be through that process until probably late spring at best. Summer. So we will not. So HUD will not be closing any grants before summer. Your deadline is next month, let's say. So you have the ability to keep spending funds that are in your line of credit past the expenditure deadline, but that is not closeout. I think, I don't know, before I guess at any more of what you might mean, write back in or call in if that's not answering your question.
Okay. Here's a very straightforward question from Joe Gray. Can costs associated with the purchase of a property that doesn't ever close be counted?
Where's expenditure deadline? Yes.
Yes.
Okay.
Well, and what we've done is to suggest, and this is one of the early rulings that Paul has helped us with, was to say that, there are going to be cases where you don't close on a property. You do the environmental review and you find out that there's toxic waste in the basement, so you don't want that house. And so, as long as that is not happening a lot in your program, we have allowed grantees to spread those costs over that activity or use as failed activity delivery costs. Basically, most of that stuff is engineering and environmental and those kinds of costs, appraisals. So those costs, and similarly costs for putting somebody through a housing counseling program that ultimately doesn't buy a house. We want to be filtering some of this stuff out. So those things are okay, and those are costs, and those are eligible, and they can be included in your budget. This is different from the home program, where you sticking those in your admin line item, I believe. So we are allowing you to charge those to the activity to which they were, in charge.
Okay. Quick question from Antoinette Patterson. She said, I missed the discussion on lump sum drawdown. Could you please touch on that subject again?
Well, the point that was being made was that an amount drawn down pursuant to the lump sum drawdown provision of our regulations, which again is that provision is at 24 CFR 570.513. Any amount drawn down pursuant to that provision is not in itself an expenditure. It's what you do with those funds that are drawn down and put with a bank that would count as expenditures. So once the funds are drawn down, put into the Third National Bank, and the grantee decides that I'm going to take out funds from time to time from that account for housing rehabilitation activities, to make loans to homeowners, or to put into individual loss reserves as loans are made by some third-party bank, that would be the use of the funds. But the lump sum drawdown itself is not a use of funds, cannot count as an expenditure. It's just a transfer of funds from the U.S. Treasury to a local bank, financial institution, because the statute says you can do that.
Okay. Question from Marcia Mack. How do we pay for audit fees for the fiscal year that ends June 30th, 2013? These fees will be due and payable after February of 2013. Should we be drawing down these funds now?
Well, audit fees are only audit payments are only allowable to the extent that the audit's performed in accordance with A133. So the payment would be made by the auditee pursuant to the circular A133 provisions. You do not draw funds down in advance for that. And normally the costs aren't incurred at the time of the end of the audit period, but when the audit services are performed. So that's when you can count the cost. And usually those costs for most grantees, I don't know, for a small grantee or maybe a nonprofit, small nonprofit, the audit expense may be paid directly, but in some cases it's usually charged as an indirect cost pursuant to an indirect cost allocation plan. So that's when it gets recognized for purposes of counting expenditures.
So unless they had some program income, they'd have to find another source of funds or whatever.
Well, again, first of all, if they're not required to have an audit performed under A133 unless it meets the $500,000 threshold. So, assuming that that's the case, then the costs that are charged to the program are charged when the audit services are provided, not as of the end of the audit period. So, if you don't carry over some program income or some other source of funds to do that past a certain date, then you may have to pay for it from other sources. If it's less than $500,000, if you don't meet the $500,000 threshold, then normally you can't charge the audit cost to the program unless the program itself requires a program-specific audit. And that's only can be done pursuant to under very limited circumstances.
Okay. Thank you, Paul. From Leah Patrica, if we miss our expenditure deadline amount by, say, $5,000, it is our understanding that we will need to return that amount to HUD. What happens to our program income?
Well, that shouldn't be not subject to recapture, if that's what you mean. So, you could lose that $5,000. Make sure you understand that you can meet your expenditure deadline by counting program income. So you may still come up $5,000 short, and then we'll have to see what happens.
But the program income, you can still use program income towards the program in the future.
Okay, thank you. Question from Kara Douglas. They have units that are occupied by what could be considered LH25 beneficiaries, but they weren't in units that were originally designated as LH25 activities. Is there some way to move those designations so they could count them?
Yes, and that would probably be a question better for on Thursday's webinar.
Right.
Okay.
One thing I want to point out, though, that once you count a unit towards the LH25 expenditure, it must remain that way as the program goes forward. So the affordability period.
Right.
So if that person leaves, you still have to make sure somebody who's 50% AMI or less gets into the unit.
So it's flexible.
I mean, the first part of her question related to moving vouchers around. So I'm assuming these must be folks who came to these units with some type of subsidy voucher.
Yeah, I mean, you got to. It's a DRGR question. Unfortunately.
Okay. Well, let me ask you that question. We have 2 or 3 questions that are very specific about DRGR and how to move things around. Do you want me to read these, or do you want to hold them for Thursday?
Why don't you read them, see if we can answer them. If not, we'll just.
All right.
You can send it to us. We'll get them answered on Thursday.
But let me just back up, Mary, on this. I think you made a good point of this. If they're talking about somebody's coming in with a Section 8 voucher, and that's the only reason that they're considering that unit to be LH25 or low-income set-aside, then Hunter's made a very good point. I mean, you can count it, but then we're going to want you to count it for the next 10 years. So you may really want to think about whether you want to do that.
Okay. Good point. All right. DRGR questions. This one is also from Leah Patrica. We do not seem to have an area in the QPR when editing the report to indicate our expenditures. The only editable field we have is to enter an overall narrative. Are we missing fields to edit?
You need to go get Jennifer.
Jennifer.
Go get somebody who knows the answer.
Mary, this is Kathy. The short answer is yes, but Leah also just submitted and said disregard her question, so she may have figured it out.
Okay. All right. Here's a question from James Castle.
Hold on.
receiving a HUD policy notice requesting we correct our draw/expenditure figures, I corrected our numbers. However, one of my activities showed us $100,000 more expended than drawn and budgeted. The fix would be to enter minus $100,000 in the current QPR, but DRGR won't allow me to doesn't read quickly, but DRGR won't allow me to access the prompt box. Well, how do I fix this? I guess he's trying to subtract $100,000 from one of the line items.
We will make sure that these questions those two questions at least, are reviewed on Thursday.
Okay.
Yeah, unfortunately, we split this into two because we're not smart enough to answer those questions.
Okay.
There is a way to do it. We just don't know what it is.
All right. Here's one question that I'm sure is a very simple answer from Andy Feiseth. Are the 120% limits for NSP posted somewhere?
Yes.
Yeah, they just updated them. Huh?
Yeah, the income calculator on the CPD website will provide you with the income limits. We've had a minor glitch, so the 2013 numbers are a little delayed. But if you go to the CPD website, you can actually follow a whole process that will walk you through how to verify someone's income and get you the number. So.
Okay. Is the 25, this may actually be a repeat, is the 25% set aside that must be met by the expenditure deadline 25% of the original grant or 25% of all funds spent at the expenditure deadline? I think you've answered that a couple times, John.
Yeah, well, it's a good point, though. So we will be looking at, after the deadline, we will be looking at 25% of the original grant amount first. We will later be looking at the balance, but you don't have to worry about the other part right now.
But it also, I think they're sort of asking more, you know, if I have a grant of $1 million and I spent $1.2 million, do I need to spend $250,000 or 25% of $1.2 million? You need to have demonstrated you spent 25% of the $1 million.
Right.
Okay. Here's a question on project closeout dates and everything from Simone Flores, and I know that you all anticipate having the guide and additional webinars. If you just, because she's asking when there'd be more information on this, so if you just like to let them know when you think you'll have more info on the closeout.
Yeah, we're actively working on a guide. In fact, TDA is helping us and doing a good job, and it's coming along pretty well. So what we're going to have is we have two things that we have to go through. We have to issue a PPD notice, and that's the piece that has Hunter jumping around these days because that's the piece that connects to the Public Paperwork Reduction Act because we don't want to ask more questions than we need.
As I like to say, it's supposed to reduce paper. It is by reducing the amount of paper in the world because I have to fill out a bunch of forms.
Reducing the net amount of paper. All right. And that will be sort of instructions for our field offices. I mean, once we get into this, that will be mostly available. But what we did was we took that and we kind of expanded on it and made it more of a grantee tool. And that's the piece that we're working on now for the guidelines. And so we will have, we should have something out. I'm hoping next month, or within about a month, that will give you an idea of how all this stuff fits together, what comes first, what comes second. The big thing you really need to worry about at this point is meeting a national objective with all the expenditures that you've made, because you cannot close out the grant until you can demonstrate you've met a national objective. We have some tips that we can that we've put into the guide for because since you won't be able to close out until possibly summertime at the earliest, we know that there's things you could be doing in the meantime, getting ready for that. So, but getting your program complete is the biggest one.
The other thing is, just sort of as a hint to everybody out there, Closeout is going to look a lot like the same process that those of you who received CDBG-R funds did. We're really just taking a lot of those forms and documents that were used for that process and expanding on them and just editing them to fit our needs. So don't be, if you're familiar with that, or if there's someone in your office who's familiar with that, they're going to see pretty much the same thing for an NSP.
Right. So let me just run through these. So this is in the ultra draft format, but we have a section called the top things that grantees can do to prepare for closeout. So the first one is to perfect your quarterly performance report in DRGR,
which we're talking about a little bit on Thursday.
Right. Confirm that all activities have met a national objective, as I mentioned. Obligate land bank property for uses that meet a national objective. We think that's going to be easier than it used to be, so maybe you can get some of those out of there. Follow your activity funding streams so that you can, look at your line of credit funds, or, so that, because you can't close until you've completed everything that you started with every dollar of original line of credit funds. So if you can segregate some of those things at this point, that might make your life a little simpler, but understand that anything that still has line of credit funds in it is going to be subject to closeout requirements, and so you won't be able to close until that point. Consider disposition strategies. How do you get rid of these properties? And then review your written agreements to make sure that all commitments are identified and will be maintained. We're looking at affordability periods. You have, talking about how you're going to handle program income, how your subrecipients are going to handle program income. We're trying to work out some differences between the state program income rules and the entitlement the entitlement program income rules. So there's a few little things there, but so those are things that if you are itchy to close your grant out, get your QPR in shape, make sure all your activities have met a national objective. Try to get as much property out of the land bank as you can. Make sure that you know what's being funded with a line of credit and what isn't. Sell your properties or put them into other uses, and review all your written agreements with subrecipients, developers, and other partners.
Great.
We will have a webinar on that, as I think Mary already mentioned.
Yep. I know there's at least one or two more planned on the closeout guide. Great. Thanks, John. We actually have a follow-up on the question about the 120% income limit. This Blair Schaefer-Bish, who asked the question, said he's looked up the income guidelines that are on HUD user, but he's heard that there's a glitch in the guidelines.
Yeah.
So is that the correct set, the one that is currently up on HUD user that says they are for NSP? Is that the set of income limits that people should be using?
I think, David's been working on that.
So there's been a delay with the income limits just because the home program is still working on the rental limits. They haven't issued the rental limits yet for 2013. So we're trying to figure out how we can separate the home program and release the FY13 income limits for the other programs. So hopefully we'll have that sorted out.
But I think the question was on HUD user. You can find the data from PB&R.
Yes.
Is that the correct data? And I don't know.
For which program?
It says for NSP.
Yes.
So that is the correct data. Okay.
Yes. So if all you want is the data, yes, you can go to the HUD user site. If you want the calculator, that's a different story.
Okay. Thank you, David. We have just 3 short questions, written questions, John, which a couple of them may be a repeat, but I'll read them right off to you. Is meeting the set-aside requirement for NSP2 measured through expenditures or draws?
Expenditures. Everything's measured through expenditures.
Thank you. The other one, And once again, it's a question on retainage. If project is completed and funds are drawn down prior to the deadline, must retainage be drawn down prior to the deadline too? You noted that work completed, including retainage, can be counted, but must retainage be expended, since you typically hold it until you close out the project?
Well, we may have to answer that question as part of the closeout notice, but if you're required, I'll have to confess, I probably need to look again at some OMB requirements, but generally speaking, you can't draw down funds until it's necessary to pay someone. So if someone if there's a retainage amount and it's required to be drawn and closeout occurs before the payment, the retainage amount is to be dispersed to the contractor, then I think that would have to be covered in the closeout agreement. And we may have to, I think we'll have to punt on that and take that up in the closeout agreement. But generally speaking, and there used to be a specific rule in the OMB circulars on this, that you could not draw down an amount that was for retainage that was to be paid pursuant to a retainage provision until the payment was actually to be made. So that's probably something we'll have to deal with in the context of the closeout documents. And if we do that, since it's going to be reviewed by OMB, it will be, even if it's otherwise be inconsistent, that would be treated as an exception to this provision. So we'll rely on the closeout notice to deal with that issue. But I'll just, Hunter, that's a good question that we should be looking at in developing the closeout notice.
Summer, do we have any other verbal questions from folks?
There are no further questions.
John, I have read all of the written questions.
Mary, sorry, there's 2 questions that came in on the chat feature. If I can just do those since
we
have a few more minutes.
No, go ahead.
Susan asks, what happens if you start a project and draw down, say, 30%, but do not spend the entire 50% of NSP3 funds by the March 7 deadline?
Okay, so I'm assuming that you've got a project here that is continuing. You will have access. I mean, it's possible that we would block your line of credit for a while to sort out the shortage. You would ultimately have access to the other 50% of your grant, and so you know what would be at risk is the 20% that you missed the deadline by. But so if the remaining 50% is enough to finish the project, then you're probably going to be okay. But if it's not, then you've got a pretty big problem.
Okay, and from Agnes, if you exceed the required 25% of original award and are still required to spend 25% of program income, for instance, $1 million in program income original requirement was based on an award of $8.5 million, but they actually spent $9.5 million. So are they still required to spend 25% of program income?
Well, we're going to be looking at 25% of total grant plus program income. So if I'm understanding the question, I know that we have quite a few grantees that went over 25% with their original amount. Then they have kind of bought themselves a little bit of cushion on the program income. But if you had a $2 million original grant and $1 million worth of program income, then we're going to be looking for $750,000 of expenditures. If you made $650,000 of those out of your original $2 million grant and only $100,000 out of the second $1 million, that's fine.
Okay, great. I think that's all the questions I see right now. Mary, one more came in here. This one's from Melissa. Our participants have been designated as developers and they receive program revenue for the sale of NSP properties. They recycle the program revenue on new NSP properties. Is this spending considered in meeting the total expenditures of the grant?
Oh, it's not program income if it's a developer, so once it's revenue to the developer, it really doesn't exist as far as NSP is concerned, right, Paul?
Yeah, that's right.
Okay, and she said she has 2 questions. There's a follow-up coming, I think. But it's not submitted yet.
Any more vocal questions? Verbal?
These were written questions.
No, I was just asking if there are any more verbal while we've been waiting.
Oh.
There are no questions.
There's Melissa's second question.
So her follow-up is the funds have not gone through DRGR systems since they are not program income, and the funds have not been returned to the city.
All right. Yeah, that's consistent with what that's a correct way to handle it. And so those funds are. Yeah, I mean, we certainly hope that you're tracking them or have they have some trajectory that lines up with what you're doing. But as far as we're concerned, they're not in the program anymore. So they don't count as spending, and you don't have to track them, and there's none of that.
And that looks to be the last of the questions then. I flipped the slide to the last slide in the slide deck. We do want to remind folks about filling out the Survey Monkey.
Okay.
We do want feedback.
Yes, we do.
John, is there anything else you want to add?
Hold on a second. Just that 20. We are coming up with some marketing materials, and I thank people who've submitted your marketing materials. We are judging those right now, and we will announce a winner shortly. But for those of you who are anxious to see some good marketing materials, you can just go to the NSP Resource Exchange and the multimedia page and look in the gallery there, the photo gallery under marketing materials. It's listed alphabetically there in the middle of the deck, and I think you see some pretty cool stuff. So thank you for sending those in. As Hunter mentioned, we'll have some more Q&As. We're going to kind of stay light on the webinars just to give you a chance to finish your spending. But if you are freaking out about anything, please do call us. Send your questions into the Ask a Question. Get a hold of your field office. Send us emails. Whatever. We are here. We are trying to help as much as we can. I have to say, at this point, we feel like we've kind of done everything we can do, and we're hoping for the best. So, but if there's anything else that we can still do, we will try to do it. So,
just real quickly, I just want to point out again, Thursday we have the webinar on DRGR and QPRs, and then Thursday, January 31st, we will have a Q&A on just sort of the deadlines to ask any last-minute questions you may have. At that point, we will have the schedule off for pretty much February, March, which I think it's just going to be another 3 or 4 Q&As just to allow you guys to ask any questions you may have.
But if we do get that closeout guideline put together, we might do a webinar on that. But even if we don't, we will make that available to you. So, and I guess I would mention one other thing is that Paul had helped us out with some questions on allocating costs. Carrying admin funds from one program year to NSP1 to NSP3, for example. We put out a short policy alert, I think it was last week. So, again, we're trying to kind of answer every possible sort of frequent question towards the end here. But if we're still not hitting it, let us know. And then, as you can see here, we'd also appreciate your feedback. We do read these. and they do help us to make the webinars better, we hope. So we value your responses.
Thank you, everybody. And thank you, Paul, for helping us out with today's webinar.
Okay.
All right. Thanks.
This concludes today's conference. You may now disconnect.